because the ETFs pinch and swell every day, because they gain assets on days when they're popular and lose assets when they're unpopular, they're forced to buy and sell physical precious metals every day. And sometimes their assets don't always include all of the precious metals that they should. Sometimes they're forced to accept delivery receipts, which is to say they're forced to accept from the counterparty, usually HSBC, a promise to deliver gold and silver against payment. Now, in an extreme circumstance of a liquidity squeeze, where the counterparty who had issued the delivery receipt was unable to pay, the shareholder of the ETF for some portion of the portfolio of the ETF wouldn't be a holder of physical gold and silver, but would rather be an unsecured creditor in an insolvency proceeding.
As a responsible person with growing concerns for your privacy and personal liberty, you want to know where we're headed and what you can do about it. We ask the experts what you need to do to take prudent and responsible action to safeguard your family's wealth and well-being, and what basic first steps will help you to be aware and prepared. ReluctantPreppers.com.
Reluctant Preppers provides educational awareness and commentary only. Opinions expressed do not constitute personalized financial advice. Viewers are encouraged to do their own research and seek qualified personal financial consultation before making investment decisions. Welcome back, Reluctant Preppers. We're privileged to have this returning guest. Rick Rule is the CEO of Sprott Asset Management. He's here with us again on Reluctant Preppers. He's here to answer your questions about investing in natural resources. Rick, thanks for joining us again here on Reluctant Preppers.
Always a pleasure, Dunnigan. Thank you very much for having me back.
What our viewers might not know is that we had the opportunity to meet in person just a week ago when I was traveling there to your office location in Carlsbad, California on other reasons, and it was a great thing to get to see you face to face, to see your office and talk with you about many of the topics that we've discussed here. And just thanks for being a host to me, as I've been a host to you over this virtual medium.
Well, we'd be delighted to welcome you back at your leisure.
Hey, we talked when we were there about your upcoming plans to relocate your residence from California, and a lot of our viewers are interested because some of our guests have talked about strategic relocation, reasons, principles, factors, reasons that they choose this or that location, and sometimes it's purely family or personal, but sometimes there's other factors involved. Could you talk to us about some of the factors that are going into your choice to relocate upcoming?
It was a hard decision for my wife and I. We were both born and raised in California, and I would say in some senses, culturally, we're both Californians. I joke that California would be the finest place on earth if Californians weren't allowed to vote. But unfortunately, we are allowed to vote, and we do some amazingly stupid things. The other thing about California is that it's so nice that while those of us who were born here are loath to leave, many people want to come. So that the California that existed in my youth and early adulthood exists only sparingly in the state now, which is one way of saying, I guess, that it's so nice that there are too many of us. And those of us who are here choose, at least from my point of view, to spend too much time trying to constrain or govern others. So at long last, my wife and I are pulling up roots and leaving California and going to Washington State, northwestern Washington, which I'm also very fond of. I went to the University of British Columbia when I was a young adult, and the consequence of that is that I became very fond of the Pacific Northwest, specifically southern British Columbia and northern Washington. So I wouldn't call this relocation a hardship data, sort of a hardship post by any questions. I love the Northwest. I love the crowding conditions. I would like a little more sun, but the truth is you can't have it all. I'm delighted to be making the move.
You talked briefly with me about other locations you considered in the past when you were considering possibilities. What other factors and what other locations have you considered?
Well, certainly at one point in time, given the extraordinary progression of taxation in California and the idiotic things that they do with my money, I decided that I would investigate moving to Puerto Rico. Several of my close friends, including Lobo Tigre, have emigrated from the United States to Puerto Rico. And from a tax point of view, Puerto Rico is extremely attractive. From other points of view, however, Puerto Rico didn't work as well for me. Living in San Juan, downtown as an example, on the water, was sort of attractive, but I looked at the elaborate security mechanisms that were put in place in private residences, and it looked to me like those were not added for aesthetic purposes, but rather for some other purpose. And I decided that if I traveled a lot, having my wife living in a place where such fortification was necessary just wouldn't be something that I could stomach. Mm-hmm. A different alternative was to live in what I can only describe as a rich old white ghetto, one of the beach communities where it seems that your status is measured by how many brown people do things for you. And I don't like that idea either. I'd rather associate with people in a less forced circumstance. So the idea that I would either have to defend my house with a fortress and a flamethrower, or alternatively that I would hire that same sort of social segregation, just didn't work for me personally. There was a point in time when I was extremely enamored of living in New Zealand, and I thought about renouncing my U.S. citizenship entirely and living full-time in New Zealand. The more I came to understand New Zealand, the more I came to understand that their political culture is advancing much in the same way that California's political culture has manifested itself. And so the problems that I was seeking to leave, I was putting myself in the way of.
I've heard that the population of New Zealand is more sheep than people, but it's not the sheep that are causing that political shift you're describing there. But we have heard that millionaires and frankly billionaires have been flocking there for various reasons to get away from the upcoming troubles in the world and that sort of thing. And I can only imagine that some of the political mindset that has affected California might be being imported there as well from those same crowd.
I love New Zealanders as individuals. My neighbors in New Zealand remain some of my closest friends on the planet. Like Californians, as individuals, I like them all. When you put them together as a collective and you allow them to vote, there's just no end of good, individual good, that we can't screw up collectively. Mm-hmm. And so, unfortunately, what I've decided is that I have to throw away many of the sort of strategic considerations and live my life in places that I like and in ways that I like. The truth is that I'm old and fat and rich and full of guile. And I think I've managed to construct a financial future so that almost no matter how hard they try, they can't conspire to deprive me of a nice living for the rest of my life. And I have to be content with that. I'm probably lucky compared to many of your listeners.
Well, a lot of our listeners would aspire to the same principle, would like to know what trajectory or what considerations that they should be at least aware of or thinking about or learning more about that would perhaps, we could all benefit if at least you could say, well, look, here's top 3 or 4 things to think about in that regards, because if this goes this way, you might want to think about this, or if that goes that way, you might want to have thought about this.
Dunnigan, my whole life revolves around risk. I even like it as an intellectual topic, never mind the fact that it's what I do for a living. And so many clients and others have talked to me about the concept of risks, in particular political risk. I've thought about it a lot. And what I've come to understand is that over 5 decades of investing, my worst wounds have been self-inflicted. It turns out that the biggest risk that Rick Rule is exposed to is conveniently located to the left of my right ear and to the right of my left ear. That isn't to suggest that Obama wasn't a risk or Trump isn't a risk, or the clown in BC, Horgan, isn't a risk. It isn't to suggest that at all. It's just that they're not your principal risks. Your principal risk is yourself. And if you manage your expectations and your expenditures prudently, somehow you will muddle through. I'm reminded of being concerned in the late 60s and early 70s when I was either a late adolescent or an early adult about the set of challenges I saw myself confronted with then. The war in Vietnam, the war on poverty, the fact that every school that I seemed to want to go to in the United States required a gas mask to get to class. And I guess like many young people, I sort of over-dramatized that situation. And I was voicing my fears to my grandfather and asking him for advice. And he started laughing. He said, we faced some challenges in my youth too. There was the Great Depression. There was World War II. And the truth is that somehow we managed to muddle through all of that. I'm not saying that people shouldn't consider all of the collective challenges that we face. I'm just saying that you need to keep them in perspective. I've had many people tell me that they aren't going to make investments because they don't like the administration. The truth is you're not going to like the next administration, and you're not going to like the one that follows that. And time value of money suggests that the time to make good investments is when they're available to you, irrespective of the macro situation that you find yourself in.
Could you return to if there's any other insights that you could share about, you said, regardless of how things play out or something like that, I think you said you've positioned yourself so you think that you're going to be covered this way or covered that way. Are there any major factors of the way that things could tip that you've said, for example, if things tip this way, it would be wise to have considered this kind of a positioning and so on?
Well, one of the discussions that you and I had last week, which you may or may not remember, is I ask my clients, assuming that they ask me for advice, to have a year's worth of living expenses in cash or cash equivalents. If you own a business, think about how much money it would take if that business suffered a 50% decline in top line sales, and include that in your living expenses because it's the business that's going to sustain you through time. Now, whether or not you hold that cash in US dollars or Canadian dollars or New Zealand dollars or part of it in gold and silver is of less importance to me than that you have more liquidity than you think you need. Some of your listeners will not have the ability to have a year's worth of cash. They don't have access to a year's worth of cash. And too often, people have used their inability to reach a goal to excuse them from setting a goal at all. A year is optimal, but if you can't do a year, start with 2 months. When you get to 2 months, scratch out 3 months. The point is that you have to have cash. Now, some people, my friend Doug Casey, is given on occasion to saying cash is trash. And when he says that, I always say, Doug, if that's the case, please give me yours. Let's assume that most of your listeners are American, although I've come to know many of your listeners, and I know they're from around the world. But let's assume for a second that they're Americans. And let's assume that, like yourself, they're concerned, and myself, they're concerned about the political and economic trajectory of the United States. Let's assume further that having cash, either in a T-bill or in a certificate of deposit, means that your savings lose purchasing power every year. I've had many people say, the money that I have stored as cash loses me 2% compounded. And what I say to that is that about once every 10 years, there seems to be a bit of an economic reset. So losing 2% is better arithmetic than losing 30 or 40 or 50%. Having cash gives you both the tools and the courage to take advantage of liquidity squeezes when they occur, rather than being taken advantage of. So from my point of view, the most important part of a financial plan is liquidity. Having the ability to sustain yourself for some period of time if you are exposed to dramatic change, which you will be. I think the second thing that I would ask people to consider, and this is beyond the reach of many, is to continue to invest in yourself and your education. Knowledge is an asset that can't be stolen or taxed. It can be lost. In my case, I probably lost plenty of it. But the truth is, investing in yourself so that you build the capabilities that will allow you to make a living in a way that's amusing to you is absolutely critical. When I'm confronted with the idea of retirement as an example, or better yet, when people talk to me about work-life balance, I say I have great work-life balance. I love my work. I'm balanced. And to be able to say that, to be able to, as I have done, investing in my education for 50 years, allows me to compete against people who are trying to compete with me for the money. I do it because I love it, and I'm competing against some young schmuck who's doing it because he or she wants a Lamborghini. There's no way in the world that they're going to be able to compete with me. So after you have liquidity, or perhaps even before you have liquidity, investing in yourself, enhancing your sense of well-being so that you do something that you love. If you do something you love, you do it better than other people. And you make money by generating utility. You understand how circular this all is. Mm-hmm. And I would say the third thing is invest before you speculate. Too many people who begin to invest have visions of 10 baggers or 15 baggers or 20 baggers. Now, the truth is I'm giving you advice that I studiously ignored in my youth. All of the money that I now invest prudently, I made through manic speculation. But the fact that it worked for me is almost proof of the fact that it won't work for most people. So I would suggest that people, when they begin to invest, understand that the idea is to make their money work for them rather than working for the money. And to invest, at least in the beginning, very prudently, in circumstances where the unanswered question about future returns is when will it occur, not if it will occur. Those are critical questions. If somebody were to get all three of those right, mercifully I have, it's funny, over time, money takes care of itself. When I decided in my late 20s that I wasn't going to work for money anymore, I wasn't going to worry about the money, I was going to worry about generating utility for other people. In other words, how I got paid was something that came after I had worked on utility. I started immediately. When I say immediately, I mean within 3 months, I started making more money than I had hitherto known had existed. It was silly. Now, many people won't be able to emulate that because they have obligations to themselves or to a family which requires the security of having a job, being real. But even in the context of having a job, putting the utility that you generate ahead of the utility that you hope to accrue will make you very difficult to compete with.
We have a couple of questions that are related to what we've just talked about, and I wanted to springboard into those. First of all, about the patience it might take to do investing rather than, as you called it, manic speculation. Yusuf Yat says, first of all, let me state clearly that impatience is bad for investors. However, playing the devil's advocate here, can you argue that it's easier for a rich guy like Rick to be patient than non-rich people? In other words, was Rick always this patient? How do you balance patience with countervailing considerations of not staying too long in, quote, dead money investments?
I don't know what a dead money investment is. I believe that you invest with the expectation of return. I would suggest as an example that investing in public markets involves understanding the delta between what something is selling for and what it's worth. And when the delta disappears, then the investment should be sold. Now, the problem is that price information, how much a share or a bond is selling for, is easy to obtain. And value information, or at least an opinion around value, is difficult to obtain. And the information is less certain. So people focus slavishly on price information. But the price is irrelevant if you don't have some opinion as to value. Warren Buffett, a guy that's done fairly well over time, has said that the ideal holding period is forever. I understand that, although I've never been a good enough investor to find an investment that I've been able to hold for that duration. But I note, and the questioner would be wise to put himself or herself through this exercise. If you look at a long-term stock chart of Berkshire Hathaway, if my memory serves me correctly, it sort of nominally came public at $16 a share and now trades in the hundreds of thousands of dollars per share. At least 4 times in the period that I've held Berkshire, it has fallen by 40 or 50% in price in the course of a year. And many investors with a shorter-term horizon might have been shaken out of that stock because they didn't pay attention to what it was worth. They only paid attention to the price action. Yet if you look at the long-term stock chart of Berkshire Hathaway in the period, say, 1980 to now, you can't see those 50% declines. The chart is so exaggerated from the lower left to the upper right that those 50% declines, yes, they were traumatic when they occurred, actually are invisible or almost invisible in the chart. And so I think there's 2 lessons that are wonderful lessons from the question. The first is that time should be your ally. If you aren't investing in a circumstance where the investment is growing at a compound rate of return over time, you shouldn't be in the investment, probably. We could talk about speculation later, which is a different art. And also that you need to focus in your investment in the delta, the difference between the valuation that's assigned by the great unwashed, by the market, and the value that you see in the business or the asset that you're buying. The other, of course, wonderful circumstance for long-term investing can be real estate. The idea that you buy, as I'm buying now as an example, very, very high-quality farmland, or the things I used to buy, high-quality apartment buildings in state capitals, where your return on capital employed increases over time as a consequence of scarcity, as a consequence of increased cost of duplication, whatever. But your cost of capital, your mortgage, stays fixed. Mm-hmm. The idea that in an apartment building you're able to raise rents 3 or 4 or 5% a year while your mortgage stays fixed, what that means is that the delta between your cost of capital and your return on capital employed grows, and it grows at a compounded rate over time. I look back, and every single piece of developed rental real estate that I've sold in my life has been a mistake. Now, that isn't to say that I didn't make money. It isn't even to say that sometimes I didn't deploy the capital at better rates of return than I would have enjoyed owning it. But the truth is, when I look at the income I would be generating now off real estate that I sold 20 years ago, in hindsight, I still feel fairly silly.
You mentioned in passing there about agricultural land. That's one of the things that people have talked about as well. There's a serious distrust among a lot of our audience about equity pricing, bond pricing, the bubble of everything it's been referred to, and real estate as well in many markets. So they tend to, and we tend to look towards things that are more intrinsically valuable, precious metals being one, but potentially productive farmland, something that you can actually put your hands on, and this is the real thing. I just remember the quote from the movie Gone with the Wind. hold on to the land, it's the only thing that lasts. But anyway, so you've been talking about that has actually been getting your attention as well. And if you could talk to us briefly about what your thoughts are in that people can be aware of.
It has. I'm currently involved in making another mistake with regards to disposing income-producing real estate. I invested fairly aggressively, for me, in very high-quality apartment buildings in state capitals, figuring parenthetically that the only business that I knew that would always grow would be government. And so employment in those state capitals would do well. And I'm not a professional real estate investor. So I'm concerned that those apartment buildings are, like their owner, myself, or owners, fairly long of tooth. And they have treated me very, very, very well. My cost of capital, that is, the mortgages, have come down to levels that I believe are unsustainably low. At the same time, the buildings that were brand new in 1990 are anything but brand new. And people are willing to pay me an amount of money for those buildings that, let's just say, I believe is full and fair. By contrast, nobody wants to own high quality upper Midwest farmland.
Just injecting in there a correlation we've had is that we've had Joel Salatin on. He's the co-founder of Polyface Farms. He lectures widely on permaculture and other things, and he's talked about this demographic winter that's hitting the United States agriculture, where, looking back, like some amazingly high percentage of landowners and farmers are approaching retirement age, and their children and grandchildren generally are not interested in that lifestyle. And so we've got this mega trend across the entire country of agricultural land becoming available. And he said, if people don't get in there and who are willing to farm it, buy that up, it's going to be bought by big investors, sometimes foreign investors, and by huge agribusinesses and that kind of thing. It's going to be a big demographic winter and wipeout of our family ownership of farming. So go ahead, just correlating what you're saying. That.
Well, yeah, I think there's really four factors that argue in favor of farmland investments. The first is, ironically, that farm gate prices have fallen by half. So the rents have fallen. So the prices have fallen. Trade war with China has, at least temporarily, exacerbated a normal and natural market collapse in grain and bean prices. The upper Midwest has faced competition from parts of the country where the weather is better, meaning the West and the Southwest. The problem is that the West and the Southwest are, for the most part, mining water, using water that isn't being replaced. The upper Midwest has a great problem. Sometimes they actually have to make the water go away. But the upper Midwest also has the advantage of serving the best market in the world, the United States, and having the ability to move inputs and also outputs by river, the Mississippi River. They're incredible advantages. And then there's the demographics that you talk about. Less and less people want to farm. So what's happening is that the 400-acre farm, the 600-acre farm, is being sold because there's no or not as many third-generation farmers that want to farm. The ones that do want to farm might be farming 600 acres of their own and 4,000 acres that they lease from somebody like me. So my idea, and I don't do this by myself, by the way, just for the record, I do it with a manager. My idea is that we buy very high quality upper Midwest farmland and we lease it to family farmers who can employ their labor and their capital in the form of machinery and processing facilities across several thousand acres and make great money, while their competitors only make good money. In fact, of the farmland that we've been able to buy, almost all of it has happened as a consequence of existing tenants of ours saying, if you would buy that block across the street, which is going to become available because the grandkids won't farm it, I will pay you X in lease. In other words, we're adding to the farmed estate of an existing tenant farmer.
That's really awesome. It sounds like it's a win-win there because they
It's
don't end up
wonderful.
being displaced. Yeah.
It's wonderful. And the professionalism that you're seeing in the generation of the sort of 30 and 40-year-old farmers that I'm talking to now, if you compare them with the farmers of my generation, including my own family, there's no comparison. These guys are really, really good.
Huh.
I mean, they are really good. They're scientists in their own right. They may be scientists in straw hats, but they're really good. There's no diminution in quality. There's an increase in quality.
There's a related question from Gary Hansen who says, could you please ask Rick's opinion on fertilizer minerals, potash, phosphate, etc., and the associated companies or stocks? They seem like one of the sectors that should always be in demand, even during recessions or depressions.
It's a very different business than farming. Let's get that out of the way, first of all. Those businesses have treated me over the years extremely, extremely well. We are in a period right now where there are oversupplies of both phosphate and potash. And the consequence of that is that the less efficient suppliers of both materials are selling product for less than the total cost of production. As an example, in the potash business, the Russian producers are trying to regain market share at the expense of other producers, particularly Belarus. And the prices are probably unsustainably low. I suspect that they could stay unsustainably low for 2.5 or 3 years. So somebody who pays attention to this thesis must pay attention to this thesis for the very, very long term. Mm-hmm. I would also tell you that if you're going to play this game, that you need to play the game with absolutely the best companies. There was a point in time in the 90s when I was pretty sure that potash and phosphate prices were going to go up. So I was able to buy lousy companies that wouldn't make any money at the then prevailing mineral prices, knowing that the price had to go up, and hence the price of even lousy deposits would go up. That game is over, I suspect, for the next decade. If you're going to play that game, you want to buy the biggest and the best, the low-cost producers. And you want to be able to be wrong for a couple of years before you're right. It's a game that you have to have a 5 or 6 year horizon in, or else you'll be whipsawed out of your position.
Back to the comment you made earlier about you said you got to know several of our hundreds actually of our subscribers because you invited them to submit natural resource companies to you, and you would offer them your ranking on a 1 to 10 scale where 1 is best and 10 is worst, and give some color commentary along the way. Very generous offer. Lumel 1202 says, Rick Rule measured in the ranking emails all companies from 1 best to 10 worst. Which companies would he measure in the range of 1 to 2 today?
Well, I need to say that I have no 1 or 2 rankings in any portfolio worldwide right now. In other words, there is no company that on my scale qualifies for a 1 or a 2. There are several 3s, some of which I'm delighted to say were contained in portfolios of your subscribers. But you will note, or you should note at least, that my rankings are on a valuation basis. And my 3 rankings are almost universally in Russia, which some investors won't touch as a consequence of political risk. But let's go back to the question just for fun. A 1 ranking for me requires that, in my opinion, the company be selling for less than half of what I believe it to be worth. Because I follow resource companies only, the company has to have a tier 1 or potentially tier 1 deposit. A tier 1 deposit being a world-class deposit that would be bought by a Barrick or a BHP or an RTZ. A deposit that will produce for 20 or 30 years and will be in the best quartile worldwide in both return on capital employed and operating cost. The company in question has to have the ability, in the set of circumstances that could be commodity pricing or something else, that a company is my own model, it has to have the ability to give me a five-fold return over 5 years. I'm not saying it will, but it has to have the ability to. It has to have a tier one management team. That is a management team that has been successful in the past at a task that's fairly well related to the task at hand. If somebody was successful in software and now they're in the mining business, I don't want to know. I want the management team to be world class, and I want them to be suited to the task at hand. And I want to see a catalyst in place that could double the stock in 18 months. So let's run this backwards. I want a world-class deposit. I want a world-class management team. I want it selling for half what it's worth with something in place that's going to give me what I think it's worth within 18 months. And I want at least the possibility, but more likely the probability, that it could be worth 5 times what I'm paying for it in 5 years. I have had over 35 years of ranking companies, 9 that I remember that were 1 rankings, that is over 35 years. Tier 2 is fairly simple. You can take away one of those variables, but you can't take away value. I can have a less good management team, I can have a less good deposit, but the valuation has to be intact. Those are very rare. I've probably had 60 2 ranking companies, maybe 70 in 30 years. The 3s, as I say, are somewhat more numerous. There is not a huge shortage of companies that are selling at less than half of what they're worth. Many of them, however, I see no catalyst in place or no hope for a 5-fold return, or I have some questions about management. They're missing too many variables to be upgraded to a 1 or a 2. And the 3s that I have in my own portfolios now will be challenging for some of your viewers as a consequence of political risk.
You mentioned, we were talking about land there for a little bit. There's a question here that starts with that, but I'll expand it to be real estate, I guess, in general. Typo says, land as an asset question. If the banks go down, who pays the collection agents and lawyers to repossess?
Well, I suspect that there will be some private investors out there. One of them, depending on price, might be, Rick Rule. What happens in liquidity crunches when a bank is unable to continue as a going concern, the liquidators often sell off the assets, that is the loans, in an attempt to satisfy the liabilities, that is the deposits. And there are circumstances where the liquidators, not having made the loans, don't understand the rationale for having made the loans, and they sell those underlying assets for less than a third party, say me, believes them to be worth. I have a high degree of confidence in and love for markets, for all their warts. And I'm not trying to say that in every circumstance that assets will be priced rationally. I'm trying to say that I would prefer to be the beneficiary rather than the victim of irrational actions by banks or by their agents in liquidation. So if your questioner believes that a circumstance might occur where there were large-scale bank liquidations, he or she might be well advised to establish a shopping list of assets that they were familiar with, where they believed that they could operate the asset better than the person who was on title now, and made plans to have enough liquidity that they could assist the bank in meeting the bank's obligation by taking that asset off the bank's hands.
That's interesting. When speaking with certain family members, they're talking about you got to think about things from the other side of the table, and that thinking of it from an owner standpoint, and not just from a speculator kind of standpoint. Brian Grant says, could you explain the difference between Sprott's physical ETF products and GLD and SLV that a lot of folks are familiar with?
let's begin that question, as I should, with an honest disclaimer. I'm a beneficiary of the Sprott product as a consequence of being the largest shareholder of Sprott. And the World Gold Council, who operates the other two products, of course, has no shareholders, although I'm a friend of that organization. The chief advantages of the Sprott product, from my point of view, are twofold. And I'm speaking from the point of view of a U.S. taxpayer, which I am. The ETF products are regarded by the IRS as surrogates for the ownership of physical gold, so that their tax treatment is the same as a collectible, meaning that the capital gains that you enjoy on the disposition of your precious metals are taxed at the collectible or your ordinary income rate. The Sprott product, by contrast, is a trust, meaning that you buy shares in a trust that owns physical metal. And that means that your capital gain, if any, on disposition, is taxed at the capital gains rate rather than the ordinary income tax rate. In the state that I currently reside in, California, the delta between being taxed as a collectible rather than as a capital gain is about 14%. I believe, as a true American patriot, that I have an obligation to pay them less, if at all. And so I regard ownership of the Sprott product, if you are a U.S. taxpayer, as both practical and patriotic. The second issue with regards to the ETFs, which is frankly of less opinion to me, although I know that some of your subscribers would argue with this, is that because the ETFs pinch and swell every day, because they gain assets on days when they're popular and lose assets when they're unpopular, they're forced to buy and sell physical precious metals every day. And sometimes their assets don't always include all of the precious metals that they should. Sometimes they're forced to accept delivery receipts, which is to say they're forced to accept from the counterparty, usually HSBC, a promise to deliver gold and silver against payment. Now, in an extreme circumstance of a liquidity squeeze, where the counterparty who had issued the delivery receipt was unable to pay, the shareholder of the ETF for some portion of the portfolio of the ETF wouldn't be a holder of physical gold and silver, but would rather be an unsecured creditor in an insolvency proceeding. For me, the tax circumstance is a certain benefit, and the security benefit is an uncertain benefit. I'm cognizant of both, but for U.S. taxpayers, the net present value of the first benefit is of more consequence than the second benefit.
Rick, you've been quite generous with fielding many different questions from a wide range of topics, and we've got a lot more left that we're not going to have time to get into. Just wanted to thank you for joining us here on Reluctant Preppers, and before we let you go, I wonder if you can stick around for another minute for a question, an extra bonus question for our Patreon subscribers.
Absolutely. While I'm at it, I'd like to do two things. I'd like to thank your subscribers for their patience. We were overwhelmed by the response with
Way to go, guys.
Portfolio review. I mean, literally overwhelmed. And I'd like to compound the felony by extending it. Anytime Reluctant Prepper subscribers and listeners would like to submit their portfolios to us, we are happy to grade them and send them back. I would only ask your subscribers continued forbearance in our struggle to keep up with the load that we have encouraged from that. We have learned an awful lot from looking at those portfolios, which has been wonderful from our perspective.
So that's emailing, I think it's rankings at sprottglobal.com.
Rankings, RANKINGS at sprottglobal.com. Give us your portfolio, names and symbols in text, please. No attachments that an old Luddite can't open. Names and symbols in text, and we will send back rankings and, where appropriate, comments.
So everyone, if you aren't already a subscriber at patreon.com/reluctantpreppers, you can become one and access bonus content for Mr. Rule and other guests that we've had on. So Rick, as always, thanks for joining us here again on Reluctant Preppers.
A pleasure. Thank you.
Hey, Reluctant Preppers, if you want to hear more of bonus footage from other guests we've had on, come on over right now to patreon.com/reluctantpreppers and access that bonus footage there. Take care.